I think people just need to get comfortable with the idea that the government writes IOUs and the private sector holds them. And it makes perfect sense when you think of them as private sector savings. People want financial assets. Somebody has to supply them. If somebody has to be in debt to supply the savings that people want, then who should be in debt? Well, the person who should be in debt is probably the entity that issues the debt that's really easy to repay. And that would be the government, right? When they issue debt, what are they promising you? They'll take the money back when you try to pay your taxes. That's a pretty easy promise to keep. They'll give you some money that they create when your government bond matures. That's a pretty easy promise to keep. And so if somebody has to be in debt, we'd rather it be the government than the private sector.
This is the MMT Podcast with Patricia Pino and Christian Riley. Hi, I'm Christian Riley and welcome to the Modern Monetary Theory Podcast. You can find us on Twitter at MMT Podcast, and you can support the show by going to patreon.com/MMT Podcast. If this is your first time hearing about MMT, you might want to listen to our first 3 episodes for an introduction, which I've linked to in the show notes, along with some other things that relate to this particular episode. And as ever, I've linked to where you can support this podcast financially via patreon.com/MMT Podcast. Support starts at $1 a month or £1 a month or whatever the equivalent is wherever you live. We're 100% listener funded. Your financial support really helps keep the show going, and your support in other ways, whether it's by recommending us to other people or just by listening and spreading the word about this stuff, really helps too. A big thank you to all of our supporters so far, and thanks as ever for the time you put into understanding MMT. Let's dive in. Welcome one and all to the MMT Podcast. I'm Christian Riley.
And I'm Patricia Pino.
And we are delighted to welcome back to the show our friend, MMT scholar, writer and teacher, Dr. Sam Levey. Hi, Sam. Thanks for joining us.
Hi, thank you for having me.
Because you're such a good teacher, we went to our patrons and we asked them what they'd like to ask you. And we had a great response. We got some good monetary nuts and bolts questions and some mobilization theory questions. This first one's about government deficits. Patricia, are you okay to read that first question?
Yeah. The first one is by Shane Doubts, and I think he's sent quite a few questions to us before. So he's a regular. He asks, hi, how does running a deficit add money to the economy when the exact amount paid into the economy when the government spends, reserve add, is removed through taxation and the issuance of government bonds, brackets reserve drain? I understand that bonds go towards satisfying the savings desires of the private sector, as they are basically savings accounts at the central bank, and they are therefore private sector assets. However, this money isn't circulating in the economy while it rests in these savings accounts. After all, is the purpose of war bonds not to reduce the spending power of the private sector during wartime? Thanks a lot.
Okay, I like this question. This is a good question. And it gets at, like, if you've ever read or talked about Thomas Kuhn, right? And Thomas Kuhn talks about paradigm shifts and the idea that, like, science isn't just this gradual increasing accumulation of knowledge, but actually it's like a series of revolutions. One paradigm overthrows another. And while there are these paradigm shifts happening, like, the different paradigms are using different words or using the same words in different ways, and so have a hard time talking to each other. And so there's a bunch of things that, you know, if you get in the MMT world and you have conversations with non-MMT people, this happens all the time. You start to realize, oh, you and I aren't using that word necessarily in the same way to mean the same thing. And so that comes down to even, like, simple stuff, right? Like even like money or deficits or things like that. So to get at this question, it depends exactly what you mean by a bunch of those words. And so there's actually more than one way to answer it. So, like, one way to answer it is to say, well, in MMT, we're much more inclined to think of the bonds themselves that the government sells as a form of money, right? Like, MMT subscribes to this credit theory of money approach that sees money, state money, government money, as an IOU of the government, and really actually sees all money as some form of IOU. And so then, like, there isn't such a sharp distinction between money and debt, like money and bonds that are, like, totally separate things, which is sort of the more mainstream way of thinking. Instead, for us, it's more like a spectrum. there's a whole bunch of IOUs out there, and some of them are like very money-like, have a high degree of moneyness, and some of them are not very money-like, have a low degree of moneyness, like are very difficult to spend or not very widely accepted, not very liquid, something like that, right? So from this point of view, you look at the bonds that the government sells, and those bonds, yeah, they're bonds, and they're not the same thing as like paper money or something, but they have a very high degree of moneyness. They're very money-like. In fact, arguably, treasury bonds are more money-like than money. There are some cases where, all else equal, you really want a bond and you don't want something else that might be called money. And so specifically, the example I'm thinking here is like, you think about large corporations that they've got millions of dollars coming in and out every day, and they're looking at what do we do with our operating funds here? And they're actually more likely to hold that in the form of government bonds than they are in the form of, say, a bank account, like a checking account, a deposit account. And the reason for that is that government bonds are backed by the money printer, so they don't have any default risk as long as the government's not going to choose to default, but the government can't be forced to default. Whereas bank money, like an account at a bank, actually does have default risk. Like if your bank goes under and you're above the deposit insurance cap, then you're going to lose your funds. And this really came to a head actually last year when Silicon Valley Bank, like that whole crisis, that was all about these uninsured deposits. And so you get this situation where these big corporations, they think of government bonds as money. And so this is very real, right? It's not just necessarily like an MMT theory thing. It's actually like out there in the world, there's plenty of reasons and times when people think of government bonds as a form of money. So that's one way to get at the question. If you think of government bonds as a form of money, then they deficit spend, they add bonds to the economy. Yeah, that's a form of money. And it's maybe not as day to day for just mom and pop. Like it's not so easy to spend that money, but it's actually not so hard either. We have very liquid financial markets. And so bonds can always and quickly be redistributed from somebody who maybe needs to get cash to spend towards somebody who doesn't, who's willing to absorb that into their portfolio. And on the war bonds issue, the war bonds that the US issued during World War II, for example, actually really the purpose of those was not so much to reduce the spending power of the private sector per se. And how do we know that? Because those bonds were redeemable. You could take them to the Treasury anytime you want. Maybe there's like a short waiting period up front, but anytime after that, and you can get your money back and spend it right away. And so that really wasn't the purpose of them per se. Not to say that you couldn't do that. You could have like an illiquid bond policy where you sell people instruments that cannot be spent or that are very, very difficult to spend. But that wasn't what the US was doing. The US really was basically trying to convince people to save by virtue of patriotism, right? It's like buy a war bond and then psychologically, hopefully we hope that will convince people not to spend their money because it's like spending money is one thing, but liquidating your war bond, that's like going against the war effort, right? There's like a psychological factor there. So it was more about that than it was about like removing the money per se.
So it's social pressure not to redeem the bond.
Yeah, exactly. So bonds as money is one way you can get at this angle. Another way you can get at the angle, though, is to ask, what do we mean by a deficit exactly? What time frame are we talking about? Because here in the question, you're defining a deficit as the government spends and taxes back and sells some bonds. Whereas a lot of the time when the MMTers are talking about deficit spending, adding money to the economy, or like adding reserves to the economy, to the banking system, they're thinking about a much shorter time span. And this is, again, another case of like the MMTers and the non-MMTers are talking right over each other's heads, right? If Stephanie Kelton says deficits add reserves to the banking system, like in her famous research paper, Can Taxes and Bonds Finance Government Spending? You'll notice that the time frame she's talking about is like a few minutes or maybe a single day. Like if the Treasury is running a deficit over the course of one day, right? They've spent some money over the course of the day. They've collected some money in tax over the course of the day. And over that, if one was more than the other, they're running a deficit or a surplus, right? And on that kind of basis, just unequivocally, you're running a deficit, you're adding reserves to the banking system, and then the Treasury will swoop around sometime later and say, well, how do we coordinate our bond sales with the central bank? What do we want the level of bank reserves to be? Sell some bonds and drain some of those reserves, right? So this time frame is a question as well. And I think that's a major source of miscommunication there too.
Let's just back up into this, sort of like get a bit more elemental about it. I think what Shane's asking is, let's say the government spends some money over a period of time and taxes some back. The stuff that's left over, that's called the deficit, or the stuff that's left in the non-government sector. Sorry, let's be real specific. The dollars that are left over are the government's deficit and the private sector's surplus. They're both the same thing. But then we're told the government issues bonds to match, not to fund, but to match the deficit. So in other words, the bonds have been issued to soak up that spending in excess of taxation. So how does anybody have any money in their bank accounts? I think that is kind of what Shane's asking.
Sure. And for that, like another direction to answer this question, you can think about how does monetary policy work and what is the central bank trying to do with their monetary policy? And like a really nice way to think about fiscal versus monetary policy is that fiscal policy is about the total number of government liabilities, of government IOUs, like including money, including government bonds, including other forms of government promises here. Fiscal policy is about the total number of them. And when the government spends, it is increasing those liabilities. It's adding liabilities to the private sector balance sheets. When the government collects taxes, it is removing those from private sector balance sheets, removing them from private portfolios.
Let me just jump in there. When you say the government's adding liabilities to private sector bank accounts, we mean that those liabilities are assets to the non-government.
Yeah, correct. A liability of the government held by the private sector as an asset. So fiscal policy is about the total number of them. Spending creates them, taxing destroys them, right? But then monetary policy is about the balance between them, the composition of those assets. What form do they take? And there's a few different kinds that the government issues. We think about paper money, you think about bank reserves, you think about government bonds. And then within each one of those categories, there's subcategories, $10 bills versus $1 bills, or 30-year bonds versus 10-year notes, or whatever. You go further. And so monetary policy is about the composition of those assets or liabilities, of those forms of government IOUs. And so you can imagine if the monetary policy is such that they have some particular breakdown in mind, like I'm just making up numbers here, for example. Suppose that the monetary policy was such that the central bank thinks of all the government liabilities here, 90% of them should be bonds and 10% of them should be bank reserves and other forms of currency, something like that. Again, just making up numbers, but okay, so imagine that's the monetary policy, that we want this specific breakdown by composition. Well, then if fiscal policy comes in and adds some more of those liabilities, and the primary way that they do that is by spending, right? They're purchasing some good or service, so they pay by writing a liability, and then they get the good or service or whatever. So now there's more government liabilities out there in the private sector. Well, then the monetary authorities have to come in and correct the composition now. Because when the government spends, they don't spend using this like perfect balance. We'll pay 90% of the people in bonds and 10% in whatever else, whatever the monetary authority has in mind. They just spend with money. And so then the central bank has to come in after the fact and rebalance it to be what they want it to be. If the treasury just added a bunch of money, then the central bank has to come in and put some of it in the form of bonds. Or if the treasury spent a bunch of money and then removed a bunch of it using bonds, then the central bank has to come in and turn some of those bonds back into money to get the balance that they want to be out there.
Can I just break in there just to say, you started this sort of example by saying, oh, the central bank decides that on this 90-10 ratio. Now, in reality, correct me if I'm wrong, you guys, but they don't go, we think the ratio should be 90-10. They look at in the States, the Fed funds rate, or in the UK, the base rate, and see that it's not where they want it. So then they do open market operations. What I'm saying is they don't control by quantity, do they? Or they don't control by ratio. They control by price.
Well, it depends, actually. Like on the floor system that central banks use now, the system that central banks use to hit their interest rate target now in most countries is called a floor system. And on that system, they do like quantitative easing. They add reserves to the banking system. And really there, they have some idea about just how many they want, right?
But they only know whether they've added too many or too few when they see the base rate changing.
Well, yeah, but on the floor system, the base rate just stays at the Fed's administered or the central bank's administered rate. right? And so it doesn't change. They just can keep adding and it doesn't change.
Right, okay.
Can I also ask, I think Shane's question may also be alluding to this idea of why is the way that the mainstream says that they're controlling spending power not correct? Why, if we're removing bonds, why doesn't that immediately cancel out this government spending and prevent potentially inflationary pressures? Am I right to think that these bonds are wealth to the private sector, as Shane is highlighting, and that you don't need to spend the bond in order for the bond to have an impact on overall spending in the private sector? So that bond can be used, for example, as collateral in a debt, right? In private debt. And do you have any idea what that relationship might be of facilitating further borrowing and therefore generating more aggregate demand as a result of the private sector having more bonds in their asset sheet effectively?
Yeah, so that's absolutely a thing. I mean, like, to me, it's a question of liquid wealth versus not liquid wealth, right? Like, liquid wealth is a wealth that either you can spend directly or you can spend without too much difficulty. Maybe there's an extra step or two involved, but you can still spend it, liquidate it down if you need to. Whereas illiquid wealth, you can't do that. You can't find somebody to take this asset off your hands. You can't find somebody who will take it as collateral for you to get a loan. And if we're talking about the government adding illiquid assets to the private sector, then that probably would be the case, that if they take away money and replace it with some illiquid asset, then yeah, we would think that would bring down aggregate demand. People wouldn't be able to spend so much. But government bonds are just not like that. They are quite liquid assets. As you say, you can use them as collateral, and there's the whole repurchase agreement market. The whole repo market is based on that exact thing of using government bonds in order to borrow, basically convert your government bonds directly to money so that you can spend it. And then there's also just the whole government bond like dealer system, right? There are the dealers that stand to make markets in government bonds, ensure liquid markets, ensure that you can always get rid of your bond, find somebody else who's willing to shift from stocks to bonds or something like that, who will take this bond off your hands so that you can spend it. And so government bonds are highly liquid wealth. Again, and this is the idea about thinking of government bonds as more like a form of money. They have a high degree of moneyness, even if they're not like the perfect form of money. And you know what? The thing about that is, I really like this frame. There is no perfect form of money. Even the stuff that we think of as money is like universally accepted. You can always think of exceptions. You can't use cash on an airplane. Paper money is just not actually money if you're on an airplane. And so even directly money does not have a perfect degree of moneyness. It's all a spectrum.
So let's move on to number 2 then. I'll read this one. It's on the same kind of theme. It's government bonds, bond issuance. This is from Thomas Clarkson. Hi, Thomas. He writes, according to the US Treasury, about 7 trillion of the 34 trillion in US national debt is composed of, quote unquote, intragovernmental holdings. Question 1, is it correct to say that 7 trillion isn't really debt because the federal government owes it to itself? At question 2, if correct, isn't the solution to the national debt problem, if it is such a problem, I'm adding that, isn't the solution to the national debt problem for Congress to allow the Fed to simply buy all the Treasury debt? If the Fed had 34 trillion of Treasury bonds as assets and Treasury had 34 trillion of Treasury bonds as liabilities, don't they cancel each other out in the US government's net worth?
Okay, so question 1 was about the 7 trillion intragovernmental holdings. Isn't that not really debt because the federal government owes itself? Yeah, that's true, right? It's not really debt. It's like internal accounting. And to economists' credit, like mainstream economists who are serious and who are thoughtful, they exist, and they get this right. There's a measure that you can search that's like debt held by the public, that like is the national debt, but excluding this portion. And the economists who are being thoughtful and serious about this will use that kind of measure, a corrected measure that doesn't include these internal government. It's really just internal government accounting. And that's not that different than corporations do this as well. You can have a department in a corporation that owes funds to some other department in the same corporation. So that's like not a debt of the overall corporation, right? That's just internal accounting for control's sake. So yeah, that's correct. That's not really a debt of the government. It's just internal record keeping. Question 2 here then is, if correct, isn't the solution then to the national debt problem have the Fed just buy all the Treasury debt, because then that would make it all internal accounting. It would be internal debt. Okay, that part is maybe not correct. And let me give you two counts, I think. One is Christian's point. Is the national debt problem really a problem? To my mind, the answer is no. Just let the debt keep doing what it's doing, and I don't really see it as a problem. Just inherently, it existing is not a problem. And we could talk about what different kinds of contingencies could happen under such and such situation. But the way I see it and the way the MMTers see it, the U.S. debt on its own is not really a problem. And this is true for a lot of other countries as well. So that's one thing. But then the other thing is, more to the point of the question, what does the Fed use to buy the Treasury debt? Okay, if the Fed is going to buy Treasury bonds, they're going to pay for them using bank reserves. And bank reserves, right, are accounts that commercial banks, the private banks, and also foreign governments keep at the Fed, right? The Fed is a bank. It offers bank accounts to its clients who are private banks and foreign governments. And so if the Fed is going to buy bonds, then it is going to be paying using bank reserves and maybe also paper money, but mostly bank reserves. And what? Bank reserves are a debt of the Fed. And a debt of the Fed is functionally part of the US government. And so a debt of the Fed is also a debt of the government. And so, yeah, they'd be getting rid of this form of debt that is the Treasury bonds, but they'd be replacing it with a form of debt that is the bank reserves. And here's the thing. The bank reserves also pay interest, and they pay right now pretty much exactly the same rate of interest. Like the yield curve's pretty flat right now, and so bank reserves, they're basically paying almost the exact same rate of interest as the bonds. So what's the benefit? Like, I like to show this picture occasionally when people on this bonds versus money thing. This is, I guess, the theme for us here. And if you look at what a dollar bill looks like, okay, have in your mind like what a $100 bill looks like. Well, if you go look for an older picture of what a US government bond used to look like when they all existed on paper instead of electronically, they're almost completely identical to the dollar bills, right? It's like one of them is green and the other one's like yellow. But otherwise, they literally almost look exactly the same. One of them says Federal Reserve note and the other one says like US savings bond or something. But in this case, they both pay interest. They're both debts of the government. They're both notes that say $100 or whatever. They're not that different. And so this kind of thing, like the MMTers, I think people accuse us wrongfully of just wanting to print a ton of money and stuff. And I say, like, I guess we could do this if you wanted. You could replace all the bonds with money, but then what's the difference, right? I mean, it's still just debt to the government. It still pays interest. It's basically the same.
And also the public may not want that, right?
Yeah, exactly. So that gets you to the next level of this question. Back to what I said earlier about deposit insurance. Bonds, government bonds, can be held by anybody. Anybody can own one, right? But bank reserves can only be held by banks. And so if you replace all the government bonds with bank reserves, then what you are doing is replacing a very safe asset that anybody can hold with a very safe asset that only banks can hold. Now, if the government buys bonds from somebody who's not a bank, then how do they do that transaction? Well, they tell the bank, hey, we're buying something from this person. We're going to make a payment to them. And they increase the reserve account of that bank. And then the bank will increase the deposit account, the checking account of that bank's customer. And so if the government is buying bonds from somebody who is not a bank, then that person will get bank deposits. They get bank money, right, in their checking account. But again, the deposit insurance limit, those deposits, that bank money, is potentially not as safe as the government bonds they were replacing. And so if you do this move, you're actually making the private sector less financially safe because you're replacing really safe assets that anybody can hold with some safe assets that only the banks can hold and some potentially unsafe assets because people would be holding bank money instead of government bonds.
Great answer. Great answer. I don't know what it's like in the States. It's probably similar, but every now and again in the financial press, we get this story about, oh, the Bank of England are unwinding quantitative easing. And in a sort of like they've got to unwind quantitative easing. They've got to get these assets off their balance sheet. And whether it's convenient or not, or whatever it does to interest rates, or whether it's kind of counter to monetary policy at the time. And I think me and Patricia have both asked each other, like, what's the problem with them just holding them on their balance sheet? Why does QE need to be unwound? I don't understand it. I've never really got a satisfactory answer to that question.
Let's see, I think it's George Selgin has like a whole book about this thing. I haven't gotten a chance to read it, but it's called Floored, and it's about like why he thinks that they should unwind the floor system, like exactly what you're saying, unwind quantitative easing. To the best of my knowledge, the arguments are usually something like, in the floor system, so the Fed or the central bank does quantitative easing and they add all these reserves to the banking system, and so now we're in a floor system. There's just abundant reserves, and one of the things about that system is, because the banking system is flush with reserves, banks don't really need to borrow from each other that much under that system. Like, most of them just have the reserves that they need. In fact, maybe even more than they want, and they can't find somebody to lend them to. So it's a bit more of a free market argument, but the free market argument is something like, when the banks were borrowing from each other, when there weren't, like before QE, when there weren't just a ton of bank reserves in the system, so banks regularly found themselves in need of reserves and would have to go find another bank to borrow from, that served like a disciplining role. That was like the banks keeping an eye on each other. Like, some bank is like, I need to borrow, and so they find a bank to lend from. And of course, that bank as a lender is going to be like, show me your books. So like, I don't trust you, or I'm only going to lend to you if I think you're a good credit risk, something like that, right? And so having this interbank lending market from this more free market point of view is a good thing. It's the banks keeping an eye on each other. It's a form of market discipline.
You see, but then when you go, the central bank comes in and buys or sells bonds on the secondary market to hit its interest rate target. So, you know what I mean? There is no free market in reserves, right? Even under the old system, it's utterly manipulated.
Yeah. And I think also, like, there's an aspect of, like, Warren Mosler would probably say, we don't need the banks supervising each other. That's what the supervisors are for. Like, that's what the regulators are for, is to supervise the banks. So in fact, like Hyman Minsky, the economist behind like the financial instability hypothesis and big post-Keynesian institutionalist, Minsky moments, financial crises, that's kind of all his stuff that he worked on. His position kind of famously was that we shouldn't even have a floor system. We shouldn't even do the system before that, before QE. We should actually go to a system where the Fed or the central bank is trying to remove reserves from the banking system, sell bonds to remove reserves from the banking system. And what does that do? If the banks now don't have enough reserves, they don't have enough to meet their needs, then they're going to have to borrow. And if they all don't have enough, then they're going to have to borrow from the central bank. Central bank creates the reserves. That's where the reserves come from. So if there aren't enough in the whole system, then banks are going to have to borrow from the central bank. And Minsky here is saying, well, that's good, because then the banks are going to the central bank on a regular basis, like maybe every day, and says we need to borrow. And the central bank gets to say, show me your books. Now I'm going to regulate you. I'm going to like show me what you're up to, and then I'll lend to you. And so Minsky's idea was that form of system, that's called a ceiling system. There's not enough reserves in the system, and that forces the banks to borrow from the central bank. But that system might be better for oversight, because then the central bank gets yet another opportunity to supervise, to do its regulatory job. Yeah, so there's different views about that.
That might be a good idea, but I don't buy this argument that banks would regulate each other. I mean, I think the Great Recession shows us that they didn't back then.
They did stop lending to each other. So they're quick to spook, right?
But think about, if banks are owning a lot of money to each other like they did before the financial crisis, doesn't that exacerbate contagion and the effect of any other potential financial crisis? I guess if we can get to a point where Minsky's idea about having so few reserves that you have to go to the central bank, but if you just doing it kind of halfway so that the banks can lend to each other, that might actually make things worse, right?
Yeah, I think it's a fair point, contagion. And yeah, I agree.
Great.
Settle that.
And to Thomas's second question, isn't the solution to buy up all the treasury debt? It makes me think of the thing that Stephanie Kelton says, and I think she put it in The Deficit Myth as well, when she's in front of a class and she says, okay, you've got a magic wand, and if you wave it, it rubs out, the national debt is going to disappear. Would you wave that wand? And all the students go, yeah, of course we would. And then she goes, okay, I'm going to give you a different wand now. If you wave this wand, then there are no government bonds ever again. And would you wave that wand? Oof, then they're asking questions like, okay, so no safe assets ever again. And really, then she goes, it's the same wand. You're asking the same thing, basically. So that is the problem with wiping out the national so-called debt, I think.
Yeah, absolutely. I think people just need to get comfortable with the idea that the government writes IOUs and the private sector holds them. And it makes perfect sense when you think of them as private sector savings. People want financial assets. Somebody has to supply them. Then you're asking the question, who should be in debt? If somebody has to be in debt to supply the savings that people want, then who should be in debt? Well, the person who should be in debt is probably the entity that issues the debt that's really easy to repay. And that would be the government, right? When they issue debt, what are they promising you? They'll take the money back when you try to pay your taxes. That's a pretty easy promise to keep. They're promising that they'll give you some money that they create when your government bond matures. That's a pretty easy promise to keep. And so if somebody has to be in debt, we'd rather it be the government than the private sector.
And another way to relax people about this whole sort of circuit of IOUs that we're talking about is IOUs are promises. You know, debt, all these negative words that it's terrible to be in debt as a person. So you think, well, if the government's in debt, the government's going through something terrible and it's all going to come back and bite us. And really, it's an obligation. They're obliged to take it back, as you say, Sam, as payment for any charge that they may levy on you, which is commonly taxation, but it could also be fines and fees. We'll be right back after this message from our sponsor. Hey there, dear listener. Our sponsor for this episode of the MMT podcast is you, the listener, and we can't do it without you. And when I say it, I mean our aim to promote the best understanding that we can put together of how this thing called the economy actually works and how we can make it better. And we think a big part of that is knowing that better is possible and that many destructive policy choices are often sold to us by falsely equating the spending capacity of a government to that of a household. The way your government spends is nothing like the way a person or a household spends, because currency issuing governments are the source of their own spending money. Unemployment, underemployment, underfunded public health services, poverty, and many other things that politicians and pundits sell to us as sad but necessary are actually never necessary. Our money system has been mischaracterized in the media and academia for decades. An electorate that knows how it works can truly change things for the better and literally save lives. So we hope you can find it in your heart to support us via patreon.com/MMT podcast, because it really helps keep the show going and we want to make it bigger and better. So thanks as ever for the time you put into understanding MMT. Let's dive back in. So we've nearly, I think, maybe answered question number 3, which is Peter's question. Patricia, do you think you could read that one?
Yeah. So Peter starts with, Stephanie Kelton on her Substack wrote, as I explained in chapter 3 of my book, Congress should dispense with the sale of US government bonds altogether if it wanted to. One, after all, no one demands to be paid in US treasuries. The government could simply write checks to contractors, farmers, civilian employees, etc., as it does now, and call it a day. There is no need to match net spending with newly issued bonds the way it's done today. Prior to 2008, this would have flooded the banking system with reserves, driving the Fed funds rate to zero. To prevent that outcome, the Federal Reserve would simultaneously drain reserves via open market operations until the overnight interest rate was restored to the Fed's usually positive interest rate target. Today, the Fed, like all other major central banks, hits its interest rate target by paying interest on reserves. So, if the government's net spending added, say, $1 trillion to the banking system, the additional reserves would simply earn whatever the Fed has decided to pay on those balances. The point is that the Fed no longer relies on open market operations in US Treasuries to achieve its overnight interest rate target. What is the mechanism by which the Fed funds rate would be driven to zero if bonds were not required for net spending? In other words, how does the presence of large amounts of bank reserves from government spending cause low interest rates? Should we start with that one?
Sure. So, the idea there is you're a bank and your business model is to manage your balance sheet, to manage your assets and liabilities and try to earn some return. And so you're looking at your assets and you're going okay, we have a lot of reserves. We have a lot of these reserves, again, account at the central bank. So we're looking at our account at the central bank and we're saying it's pretty big. And then you think, how much of this do we need? Okay, so what do we need it for? Well, the banks use reserves to make payments. So if we have a lot of payments, we're going to need some reserves. The banks might have to meet reserve requirements. Right now, not so much, but at various points in the past or other places, reserve requirements. The banks are just required to hold some reserves. So, okay, maybe they'll need some reserves for that. But otherwise, they don't do a ton. They just sit there. And so you'd think the bank is thinking, well, if we can get rid of some of these reserves, we might want to do that. And why would we want to do that? Well, because if we get rid of them, well, we could have some other asset. We'll use these reserves, we'll spend them, we'll buy some asset with them, some asset that is going to earn us a higher return, a higher interest rate, like maybe government bonds, but maybe any other asset that we might be able to buy from somebody who will take these reserves from some other bank that is going to allow us to earn a higher return than what the bank reserves are paying. And if banks can do that, then they want to. And one of those kinds of things they can do is lend those reserves to some other bank. So the interbank market is like a brokered market. In the US, we have something like 4,000 banks. And so some bank at the end of the day or near the end of the day, they call up a broker who, somebody who is in this market and is keeping track of what's going on. And they say, hey, we got some reserves and we'd like to lend them to some other bank. Because why? Because we'll lend them at some interest rate that's higher than we would get from just holding them. So we'll make a nice profit from doing that. So, they get on the phone to the broker. The broker connects them with some other bank who wants to borrow, who needs the reserves, right? And they make a deal and, okay, great, we'll lend you the reserves. Typically, it's for a very short time, like overnight or a few days or something. We'll lend you the reserves and you'll pay us interest. And great. So what is the interest rate going to be in that market? Well, to some extent, it depends on what the overall level of reserves in the whole system is. Because if there's a lot of reserves in the system, like just way more than the banks need overall, then a whole lot of these bankers are getting on the phone trying to lend, and not very many of them are trying to borrow. And so the lenders are trying to get the borrowers, right? They're like, I want to lend to earn this interest. So they're competing against each other. And when lenders compete against each other, right, you think the interest rate is going to go down because the borrower is going to choose the lender with the lowest interest rate. So a lot of reserves, these banks competing against each other to lend to other banks drives that interbank interest rate down.
And so there was kind of an add-on there, wasn't there? So yeah, basically banks can't lend to each other when everybody's got enough reserves or more than enough reserves. So there's like no tension in the system and therefore the interest rate falls to zero.
Well, the next question is just what is the mechanism by which open market operations drain the reserves? So how does this lead to the Fed's preferred rate interest target? I think you've half answered that, but is that basically open market operations as just issuing bonds, right?
Yeah, so open market operations, that's just the nice fancy central banking term for the Fed, the central bank, buying and selling government bonds.
That is different to bond issuance, isn't it? They're in the secondary market.
Exactly, the secondary market. When the bond is issued for the first time, there's like a whole auction procedure and it gets like the identifying security number and there's like a procedure there for a new issuance of a security. But then there's the secondary market where the bonds trade, people who have them can sell them to somebody who wants them or borrow against them or something like that. And so that's what open market operations, it means, like the Fed uses this term a lot, they're acting in the open market. They're buying bonds in the secondary market or selling bonds into the secondary market. So drain reserves was in the question. What is the mechanism by which open market operations drain the reserves? So what the Fed is doing here is they're going to sell some government bond, and they actually keep a portfolio. They have the system open market account portfolio. And so that's just like bonds issued by the Treasury, the US Treasury, that the Federal Reserve owns. And so the Fed will sell these bonds, and imagine that the Fed sells the bond to a bank. Okay, so the bank is going to get the bond, but they don't just get it, right? They're going to have to pay for it. And so how do they pay for it? Well, what kind of payment is the Fed going to accept? The bank would tell the Fed, hey, I've got this account, I've got a reserve account, right, at you, the Fed. Let me use that account to pay for this bond. So go ahead and decrease the value in my reserve account by the market price of this bond that I'm paying to buy this bond, right? And so the Fed will decrease the size of that bank's reserve account, and like that's it. There's less reserves in the system now. On the other side, when the Fed buys bonds, let's suppose that the Fed is buying a bond from a bank. Okay, so the Fed is going to get the bond, but then the bank has to get paid for the bond. right? And so the bank is saying, well, what kind of payment I'm going to accept? Okay, Fed, you can pay me my reserve account, increase my account. And so that was more reserves in the system. The Fed just increases the size of that bank's account. There's another layer here, which is like, what if the Fed is doing open market operations with an entity that's not a bank? What if they do it with just some corporation or something like that, right? And in fact, the Fed, who they actually deal with would be the primary dealers. So the primary dealers are government bond dealers. They're big financial institutions, usually like bank subsidiaries. And they have a special relationship with the Fed. The government bond market is huge. I mean, it's trillions of dollars and there's tons of people. You might own some government bonds. The Fed doesn't want to have to deal with like finding these people all the time, right? Nobody does. And so they go to these primary dealers that the Fed has a special relationship with. And anyway, so the Fed will, let's say they sell a bond to the primary dealer. Well, the primary dealer has to pay. And so they're going to pay from their bank account. So the bank is going to decrease the size of that bank account. So now it's not as big anymore. The dealer doesn't have the amount of money they used to have because they got the bond. And then the bank has to make the payment to the Fed, and they pay using reserves. And so that's how the reserves get drained.
Presumably they sell it at the discounted rate, right?
What do you mean?
I mean, the dealer wants to make money out of those bonds, so they would sell it on for a higher price than what they bought them at.
Yeah, so the dealer business model, the way they make money is that they have what's called a bid-ask spread. And so that's like them saying, hey, we'll buy bonds at this price, and we will sell bonds at a slightly higher price, right? And the difference between those two prices is the bid-ask spread. And so that's how these dealers make money as intermediaries. They make money from transactions, right? They're always buying low and selling high. And so the more business they do, the more money that they make.
It's because I remember Bill Mitchell calling QE corporate welfare.
No, he calls government bonds corporate welfare.
More generally, yeah. Oh, okay.
Yeah, I would say. Well, and it's the same thing that Warren says as well, that you're paying basic income to people who already have money in direct proportion to the amount of money they already have. So it's a really backward basic income scheme for people who already have money.
Yeah, I think there's like sort of two issues here, right? Which is like, number one, the interest rate, right? Which is like, yeah, it's the risk-free interest rate. That's what people call the US Treasury interest rate because they print the money, so they're not going to default on the bond. So it's risk-free. And so then you say like, well, kind of a basic idea in finance is that there's a connection between risk and reward. In order for someone to be willing to take more risk, to do some, you want to invent some new product or something, but you don't know if it's going to pan out, right? Well, in order to take on this big risk, there has to be a big reward. And so there's supposed to be this link between risk and reward. And if you're not taking on a lot of risk, why should you be getting rewarded? Like if you're just making easy money, why should that be very profitable? And so a lot of MMTers are in favor of low or even zero interest rates for the risk-free rate on the basis of, hey, it's risk-free. Like, why are you getting paid for this? That's just a handout for the wealthy, basically. Mike Posner says a basic income for people who already have money. So that's one issue. And then another connected issue is like, we have all this infrastructure that runs all these markets. We have the government bond dealers, like I was just talking about. And earlier I mentioned like, oh, there's bank reserves, like only banks can have reserves. And so doesn't this kind of thing, this way that the government only deals with certain entities and won't deal directly, they won't deal directly with you or me. They won't buy government bonds from you. Only you're not a primary dealer, right? And you can't get a reserve account at the Fed because you're not a bank, right? And so then there's the question of, doesn't all this limitation, doesn't that just create middlemen? It just like empowers these intermediaries to profit from their privileged positions. Government bond dealers, they make money. It's a good business to be in. And so the question is like, should we be supporting that, or are we just enriching the middlemen here?
Yeah, I think we know where we all stand on that question. And so Peter gets it right, I think, at the end of his question, because he then says, is that Fed interest rate target, because what we've been talking about is the Fed adds reserves into the system adds or drains reserves from the system in order to hit its interest rate target, or it used to before the floor system. And then Peter's asking, is that Fed interest rate target the same as the interest rate set by the Fed to supposedly curb inflation? And I think the answer is yes, in terms of like they set that one rate basically. There's a yield curve beyond that, but they set the overnight rate basically.
Yeah, so the central banks have all gotten in this game of like, they tend to want to directly set one interest rate, and they have decided it should be the short-term, overnight, interbank interest rate. But that's not necessarily the interest rate that's really important for inflation. If you ask the Fed which interest rate do they think is important for inflation, well, they'd say it's the longer-term interest rates, right? Like the 10-year and 30-year interest rates, because those interest rates are what businesses are thinking about. Like if a business is going to do some big investment project that's going to take 10 years to earn the money back, okay, so they're borrowing for 10 years. So that's the interest rate that's going to affect business decisions. And the whole point of this inflation target deal is you try to affect the amount of spending, investment spending that businesses do by changing the interest rates. And so what the Fed does, the other central banks do, is they set this short-term interest rate and they hope of all hopes that the long-term interest rates will also follow the short-term interest rate that they just set. And then that will influence business decisions, which will affect investment spending, which will then affect inflation. So that's the idea. Does it always work? Well, kind of not really. Like what you find tends to happen is like when they cut short-term rates, a lot of the time the long-term rates don't move that much. The long-term rates they just seem to have more inertia. They don't move nearly as quickly as short-term rates do. And so it's definitely part of the question of how well does this system actually work?
And then the very last thing Peter says, he asks, is it fair to say the lower the reserves, the higher the federal funds rate, and the higher the reserves, the lower the rate?
Okay, that is a great question. And it's a great question because a lot of people think that is true, but that is actually not true. It is actually incorrect to say that the quantity of reserves and the federal funds rate just move inversely to each other. What actually happens is something more like this. There's some level of reserves that the banks just simply must have, and they really can't have less than that. They need to be able to pay each other. And if they don't have that reserves, they just can't make those payments, and then you have a banking crisis. And on the other side of that, they don't really need any more than that. And so as soon as they have that amount that they need, they're starting to look to, well, what else can we do with these reserves? Can we loan them to try to earn some more interest, something like that? And so if the Fed adds more reserves than that, then the level of the Fed funds rate will just drop. And in the old days, it would drop to zero. And now, as like per the quote from Kelton's book, where it drops is to whatever level of interest that the Fed is paying. And the idea there is like some bank is looking at this and they're going, well, if I just hold the reserves in my account at the Fed, I could earn 5% or something that the Fed is paying me to hold them. Or if I lend them out, I could earn, let's say, 4%. Like if the market rate was less than that, I'm not going to do that, right? Like why would I lend at 4% if I could just do nothing and earn 5%? And so no bank is going to lend at a rate below the IOR rate, the rate that the Fed is paying. And so that's supposed to be the floor for the level of interest rates. And that's why it's called a floor system. Because in a floor system, what the rate that the Fed pays that's supposed to be the floor is also the same thing as the target. And so to change the target, what they do is they just change the floor. They pay more on, like the Fed goes from, they say, instead of paying 5, now we're going to pay 7. And then the interest rate goes up to 7. Or they say, instead of paying 7, now we're going to pay 2. And the interest rate goes down to 2 or something like that. So anyway, the idea here is if the level of reserves is beyond the amount that the banks really need, then the rate is just going to drop right down to the floor, whatever the floor is. On the other hand, if the rate is less than what the banks need, then the banks, like the Fed has removed a bunch of reserves and now there aren't enough in the system to meet the bank's needs. And in that case, the banks are thinking, well, crap, we really need to get reserves. We got to borrow them from somewhere. The interest rate is going to rise and it's going to keep rising because they need these reserves and there aren't enough of them until what? Until they hit the ceiling, right? If there's a floor on one side, there's a ceiling on the other side. But what is the ceiling? The ceiling is the rate at which the central bank is willing to lend reserves to the banking system. So all central banks have some kind of lending facility. And in fact, in the US, we have several different lending facilities by which the Fed will lend reserves into the banking system. And if they're doing things right, the interest rate they're willing to lend at is high. It's definitely higher than the floor. And that is designed so that the banks don't borrow from the Fed unless they actually need to. But at some point, they need the reserves bad enough that they go to the Fed and they borrow them. And at that point, the interest rate stops rising because the Fed is going to lend to you whatever you need, right? Whatever you need to borrow, the Fed's going to lend it to you because the Fed wants to make sure that the banking system keeps working and we don't have a banking crisis. And so that would be...
lender of last resort.
Exactly, lender of last resort, right? And so that system is called a ceiling system because in that system, the market interest rate is just whatever the Fed set, whatever the central bank sets as the ceiling. Yeah. And so back to the Minsky thing from earlier, Minsky is saying we should have a ceiling system. We should have the banks trying to borrow from the Fed all the time so that the Fed can look at their books. And so that happens in a ceiling system. So you have a ceiling and the floor system, and there is this difference. Like you add a bunch of reserves, you get to the floor system. You remove a bunch of reserves, you get to the ceiling system. However, we're not in between. So there's this region in between where you're like, there's not quite enough reserves to force the banks to borrow from the Fed, to force them to the ceiling. Not few enough reserves for that, and not too many reserves such that the interest rate falls down to the floor. So somewhere in between. And this system gets called a corridor system. And it's called a corridor system because you have like the floor and the ceiling, and you're living in between those two. So you think of it as like a corridor, I guess. I'm not sure if the lingo, like the metaphor really works or whatever, but that's what it's called, a corridor system. And in that system, then you kind of think, okay, then is it true? Then is it true that if we remove some reserves, but not a ton of reserves, like not enough to drive us to a ceiling system, but we still remove some, does that make the Fed funds rate go up, right? And even then, it actually turns out to be not the case, to be not true. The way that the corridor system tends to work is that this level of reserves that the banks need is basically like pretty inelastic, pretty like, it's just like, here's the number and that's exactly what it is. And even just like a little bit more or just a little bit less is enough to throw things off. We just need this number. And so the Fed's job in a corridor system is to make sure they always have whatever that number is. So then you ask, well, what about interest rates? How do the interest rates come into play? And that comes into play like this. When the Fed was running a corridor system, they observed that there's something that they call an announcement effect. And what that means is when the Fed wanted to change the interest rates, they would just make an announcement. They just say, hey, we're raising rates 25 basis points or something. We're raising rates 0.5%, whatever they're doing. We're raising rates, we're cutting rates. They just announce it. And even without them doing anything, they didn't do any open market operations or anything. They didn't change a thing. The interest rate would just change. The banks would just do what the Fed said.
Don't fight the Fed.
Yeah, don't fight the Fed, right? Yeah, and why are they doing that? Because, of course, if you do try to fight the Fed, then they'll go in and do something. They'll remove some reserves or whatever. And so the banks kind of know that there's no point. Just do what the Fed says. So the Fed didn't even have to actually add or remove reserves for that purpose to change the interest rate. So a lot of textbooks even get this wrong. Textbooks will say, like, if the Fed wants to reduce the interest rate, they add reserves, right? But it's not true. Back when we were on a corridor system, when the Fed wanted to change the interest rate, they just make an announcement and the interest rate, the market just moves straight there without them doing a thing.
Yeah. Now that's making me think about Japan. Don't fight the Fed. And all these people that have been sort of making what I believe is called the widowmaker trade, because what the Bank of Japan are doing is they're not just controlling the ultra short term, the overnight interest rate, they're controlling the whole curve right the way out, right? And the market every now and then, or I think they've stopped now, but every now and again, they think that the Bank of Japan aren't going to be able to do it. And it's been decades now. And no, they always do it. It's flat all the way out, right? It just makes me wonder, what are they thinking? I mean, do they think they've got some kind of inside information? I've just no idea.
I think there's something about money. There's something about the morality of money that makes it really hard for people are just grilled with this whole mainstream story about barter and metalism and like where money comes from and money as a creature of the market and stuff. And it's just really hard if you believe that to accept like fiat money and that government has power. It's about power, right? It's like people have a hard time accepting that we live in a hierarchical society and government has more power than you. And a lot of times people want that not to be true, but it is true. Now we talk about democracy, right? How do we control that power? And so it doesn't have to be unfair or unjust just because the government has power over you, but they do have that power. And so I think the rubber hits the road with this money question, because why is it that the government is able to do this forever? Why can they just peg the yield curve forever? Normal borrowers can't do that, but the government has the money printer and the government has the gun, right? What's standing on the other side of the money printer is the gun. If you don't pay your taxes, something bad happens to you. And that is why the government has this power. And some people have this just primordial urge or something that are brought up in this mindset that says there is no such thing as hierarchy or something like that. I don't know exactly, but have a hard time accepting that. And it shows up in their bank accounts sometimes. You take losses for years because you're committed to this trade that's based on your worldview that's wrong. And then also, of course, there are the people who are grifting, right? Like I saw a thing the other day that was like a tweet from Peter Schiff. You guys know Peter Schiff, right? And the tweet was like Peter Schiff saying like, I predicted hyperinflation in 2008 and that might have been wrong, blah, blah, blah. But it's still like right around the corner.
Well, eventually he'll be right? I mean, given enough years, maybe.
Yeah, he predicted 20 out of the last one hyperinflations.
But the thing is, if you predict it every year, at some point we'll have it. And then he'll be like, see, I told you 60 years ago that it was coming.
Yeah. But in their worldview, like, again, it's a worldview thing. In their worldview, fiat money is inherently unstable because it has nothing behind it. There's no gold, right? And we say, no, there's something behind it. It's the gun. And they go, it can't be that. Because if it's that, then the government's like superior to me somehow. And I'm just like, oh, geez, anyway. But then part of it is the grift, right? Is that these people make money from, they sell gold or whatever. They're making money from spreading this kind of thing and tapping into those feelings.
That was the MMT Podcast with Patricia Pino and Christian Riley. Don't forget, you can support the show through Patreon, starting at $1 a month and get access to patron-only episodes. You can do that by going to patreon.com/MMT Podcast. You can also find me on Twitter at MMT Podcast, and you can find Patricia on Twitter at Patricia N. Pino. And you can email us at mmtpodcast@outlook.com. Thanks for listening, and we hope to hear from you.